Good morning, ladies and gentlemen. My name is Ryan Sutar. I'm one of the senior investment managers here at Sharewise, and we're here this morning with Iain Dunstan. Now, Iain is the managing director and CEO of Gratifii. Now, he's been kind enough this morning to lend us his time and expertise regarding the company. He's going to start us off by giving us a brief presentation. He's going to update us and introduce us into the company. And then, as always, we're going to open up the floor to a Q&A component. Now, ladies and gentlemen, if at any point throughout the presentation you have questions you'd like me to ask Iain, please submit them through using the Q&A function on Zoom, and then I'll ask them afterwards during that Q&A component. Iain, thank you again for your time this morning, mate. The floor's all yours.
Great. Thanks, Ryan. So I'll hopefully share my screen successfully here. You got that?
Sure do.
Great. Thanks, everyone. So, yeah, an introduction into Gratifii. So Gratifii is probably if not the largest, one of the largest suppliers of incentive, reward, and loyalty programs and services to enterprises in Australia and New Zealand. Yeah, we're probably the only one that source all of our content direct to supplier. We don't use wholesalers. We have a direct relationship with every product that we provide on our platform. So, the company over the last 4 years has grown from revenue of about $2 million to where we currently sit today at about 85 million and growing. And the beauty is the space of incentives, rewards, and loyalty in times of cost of living pressures is an extremely exciting space to work in. We are to a certain extent counter-cyclical, that people start looking more for bargains as times get tougher. And if you think about it, almost every company except mining companies will have some form of incentive, reward, and loyalty program. So that's retail, hospitality, travel, all different airlines will have some form of program in their business. So it's a huge market. It's estimated to be around about $26 billion a year in Australia and New Zealand, and continuing to grow. So we think we're in a very good space right now, and things look pretty exciting for us. So what do we do? So we provide not just the loyalty and engagement program. So we design the programs for people. Is it points? Is it cashback? All the different components of it. What sort of content do you want? What do you want to do? What results you want? And then once we design the programs, we'll then go and source the content for those programs from our suppliers. Now, that can be anything. Black Friday is a particularly exciting time for us. We're doing a lot of programs for Black Friday. We announced recently we've done a multi-million-dollar project for Coles for Black Friday, for Coles Online. Anyone who spends, I think it's $50 on Coles will get a free Hoyts movie ticket. That's our program. We're running that for Black Friday for Coles. They're excited. It's a great program. And that's just an example of some of the individual things we can design and do with large corporate clients. Then, as we work with these clients, we'll do collaborations, sometimes new product launches, branding, those sorts of exercises. Well, then with certain clients, we do their marketing, so we have EDM services. So with some of our clients, we'll work with them to do weekly specials, source one-offs for them, and we'll send out all the content. We build a lot of websites for people for their rewards. And the beauty then, we load it all onto our own proprietary technology, which we also license to companies. that's built specifically to do, loyalty and rewards and engagement programs. So state of the art, and currently used by over 85 clients in Australia and New Zealand. So it's very functionally rich and fit for purpose. Who do we sell to? And this is the exciting thing for the business right now. Our largest part of our business is member organisations. Our biggest clients are the motoring organisations, super funds, health funds, enterprises with members. We're particularly strong in that space because we've had a long-term engagement with those type of organisations. So we have a lot of member-specific functionality and products. So that's a great area for us. But the exciting thing going forward is customer programs and employee programs are far, far bigger opportunity for us. As I said, like with Coles, we've done the Coles program recently. Coles has been a client for a long time. We also have customers like Alinta, that we do rewards for their members, and people that buy a new house, we might give them a gift, those sorts of things. So the customer space for us at the moment is a smaller space for us in terms of existing clients, but certainly a massive opportunity going forward. Similarly with employees, we have some large employee clients like Westpac and again Coles, Wesfarmers Group, all across Bunnings, Kmart, Target. We do all their employee recognition programs, but it's not a huge part of our business at the moment, but it's a really exciting opportunity to grow into that space and grow the business going forward. And so similarly, channel sales is very strong for us. That's where we go through franchises or resellers. So we have automotive clients like NGK spark plugs, where we engage with 5,000 independent mechanics to ensure they sell NGK spark plugs ahead of the competitors' spark plugs and their brake pads and all their other products. We also have health and wellness. We do 72 franchises for the Fab Group, which has Casey beauty clinics across New Zealand, franchised. We incentivize all of their franchises, run programs for their salespeople and reward them accordingly. So the great opportunity for this business is we can expand out into all these new areas, which create lots of opportunity for us to grow over the future. So even though we've grown from 2 million to 85 million in 4 years, there's still a lot more upside for us to grow. Recently, as recently as this week, we finalised acquisition of one of our major competitors, Club Connect, which we had RAC in WA, RAA had Adelaide and RACV, whereas they had RACQ and NRMA. So we brought all the motoring groups together under one umbrella. This has created, great opportunities for us. The beauty is we now have 23 million people or individual accounts on our platform, which there are very, very few organisations in Australia that have that reach, that we get to into 70% of all Australian households and 60% of all New Zealand households will have some access to our customer base. So that gives us really great reach for people to launch new products or for us to get out with new opportunities. We now have over 5,000 products sitting in our catalogues for these consumers to use through these brands. And now that we're at 85 million of revenue, we'll get substantial operating synergies going forward to increase our profitability. So, we've come from, for a company with today a market cap of $16 million, we're doing over 84 million of revenue. We've got underlying EBITDA of 3.2 million. We're accessing 23 million individual accounts. We've got scale, we've got products that very few companies can match. We currently have over $4 million cash in the bank, and we have a market cap, as I said this morning, of 16 million. So we think there's massive upside in where we can go with this business. Delving into the Club Connect acquisition, it was a very profitable business. There was obvious synergies between the two businesses. They were particularly strong on the reward side. We were stronger on the loyalty side. So combining the two platforms made sense. It picked up an additional 8 million accounts for us. So we went from 12 to 20. And we have a huge number of cross-selling opportunities. We're already speaking about bringing loyalty software into one of the automotive organisations as we speak. They also had a very good 7-year exclusive contract with the Red Balloon Group for their experiences. We can now bring those out to all of our other 80 clients that we have. So it's a great cross-sell opportunity between the two groups. Rapport is in New Zealand. Acquiring them is seen as logically, New Zealand businesses don't want to deal with a company that doesn't have a New Zealand office. Said we had 4 or 5 existing New Zealand clients, but it was very difficult dealing with them in a different time zone, not really being in the country. So acquiring Rapport with a revenue of about $4 million and making a bit over 150,000 a year for us was a logical acquisition. They had One New Zealand, which is ex-Vodafone, and the Automobile Club in New Zealand, which fits perfectly in with our strategy and where we're going, creates more upsell and cross-sell opportunities. And between One New Zealand and AA, they had about 3 million accounts. So that takes us from 20 up to 23 million accounts sitting on our system. So, and we get some very, very good people in New Zealand to help us grow there. So again, more growth opportunities, more exciting opportunities, more enterprise clients to work with, and all part of our strategy to continue to grow and be profitable going forward. Looking at the pro forma, you can see here, and this is before no new sales, just as at time of acquisition, looking where we are. Pro forma run rate as of today is a bit over 84 million of revenue and a bit over 3.1 million underlying EBITDA. So, we expect to grow that substantially over the next 12 months, but that's our starting point. So, we think it's a particularly good opportunity for a company that's doing these sort of numbers, as I said, with a market cap of 16 million and 4 million cash in the bank, and a great opportunity and in a very good market segment that is counter-cyclical and very attractive in a market where cost of living is the major issue on everybody's lips. We're particularly well positioned to work in this space. As I said, across the board, we have, approaching 100 million companies that use our services. And as I said, you can see we go from financial services, healthcare, insurance, retail, IT, students, health and well-being, super funds, automotive parts, health. One exciting one is to work with EML. We're now able to launch our own branded gift cards. for our clients. So that's a particularly strong partnership we have with them. They run, they've got over 500,000 people on their salary sacrifice programs. And we're seeing that relationship with EML go from strength to strength in terms of cross-sell going forward. So it's a great opportunity. We have spent a lot of time setting ourselves up for growth and to go forward. You've seen last year, we're actually the third fastest growing company in Australia on the Financial Review Fast 100, which is a good testament to the things that we're doing right. We've also spent a lot of time and effort getting ourselves ISO 27001 certified. If we look going forward through December and January, we turn over approaching $500,000 a day of sales. So with those volumes of credit cards and cash going through the system, we've spent a lot of time and effort ensuring that we are completely secure. I don't think you can spend enough time and effort on security in this market. And we've also gone forward to be able to, get ourselves carbon neutral certified by the Australian government. It's not a greenwashing one, it's a proper government climate active. So that's particularly important for supply chains up and down. So not just for our customers, but also our suppliers. So we've spent a lot of time and effort getting ourselves into a position where we can continue to grow substantially and have the infrastructure in place to allow us to continue going forward and to take advantage of the opportunities that we find in front of us right now. We have a very strong pipeline. We're working with new opportunities on a daily basis. We're adding new companies to our stable, every month. We probably add 4 or 5 new customers every month. So it's a very exciting time for us. It's a very good market space. It's anticipated, it's measured that the loyalty and rewards marketplace in Australia is about $26 billion per annum. So there's plenty of room for us to grow in that. So we think currently we're particularly well positioned for the rest of FY25 and into calendar 25 to continue to deliver for our customers and grow the business, not just horizontally, but vertically as well, and continue to deliver for our shareholders. So that's Ryan, that's the company in a nutshell. Particularly exciting time.
Very exciting stuff, Ian. Thank you very much. Now, we will open the floor up for questions. We've already got a couple submitted, but obviously I'll just kick us off. Now, obviously it appears the Gratifii has gone through a plethora of changes over the past 6 months. Outside of the acquisitions, what changes have occurred in the last 6 months that have actually really significantly impacted Gratifii?
Yeah, look, the business has continued to grow. I mean, even from, without the acquisition, we grew from sort of 18 million to 30 million. The other thing is that this acquisition has taken nearly a year to put together. So we first engaged before Christmas last year.
Yeah.
We did have a couple of big programs that we didn't go live with because we knew this was happening. So there was probably about $6 million of revenue that we put on hold till this was done, which we're now in the process of implementing.
Yeah.
So, we were growing in our own right, but we had been working with Club Connect for nearly a year to put this together.
Okay. All right. Well, now, just one other from me, then we'll pivot to some recently submitted ones. Now, obviously, you guys, when you consider the entire group as a whole, you're talking about an $85 million revenue company. When it comes to future growth over the next 3 to 5 years, what are the key drivers going to be?
Yeah, so as I touched upon, the growth is to extend our I guess, dominance in the member space out into the employee and corporate space. We're underrepresented, particularly in the corporate space. We've probably only got 10 corporate clients. So, yeah, that's very much where we're focused right now, is on the corporate space to grow that, but also employee space. We've probably only got about 10 clients in the employee space. As I said, we got corporate and employee are much, much bigger markets than members, yet we're driving, close to 60 million of our 85 million out of member-based organisations. So when you think about it, if we can get 60 million out of the smaller space, yet we're probably only getting 10 million from employees and 10 million from corporate, we've got massive amount we can grow. I mean, the sky's the limit on employees and corporate. So they're the obvious places we'll go to grow.
Of course. Well, thank you for that one there. Now, just to some live answer questions here. Now, the first one I've got is, what is the strategy with excess capital going forward? Will the company look to acquire using non-dilutive acquisitions? Yeah,
I mean, definitely it's a scale game.
Yeah.
We'll, when we have excess cash in the new year, we'll look at, some of our smaller competitors or some specific pieces, like we want to grow, not just horizontally, but vertically up into more digital marketing services. So we have this large client base that we're doing employee, the reward side. We want to get more into the add-on marketing and digital marketing services. So it may be in that space. So we have a clear path, both horizontally and vertically, where we can grow, and where we can target acquisitions in the future.
All right, well, thank you for exploring that outlook. Now, moving on here, will the share register be looked to be improved in the future through buybacks?
We just recently completed a buyback, so there won't be any future buyback, but there is a consolidation after our AGM at the end of this month.
Yes, I did see that one. Now, just another one here on the topic of the share registrar. Can you comment on Regal's building their stake in GTI to 19.44%? How supportive are they as a shareholder?
Extremely. I mean, they've been on the register for 12 months and have consistently increased their holding. In meeting with Phil, he said, I like companies that grow. If you keep growing, I'll keep being there with you. So, yes. We see ourselves continuing to grow. We have a great pipeline, some great initiatives. So he's been very supportive and continues to be supportive.
Well, that's obviously very good to hear. Now, just some live submitted ones. Participant asked, what is the strategic factors that will lead more customers to Gratifii, and what is the limit of your platform in regard to scaling top-line revenue?
The beauty of the platform, it is, we could put the world on and it wouldn't run out of room, metaphorically speaking, of course. It can scale tenfold with ease. One of the interesting things is we've just recently, and this gives you an indication of where the company is going, we were recently able to get the CTO from Qantas Money to come here as CTO, and he's looked at our platforms and gone, wow, these are unbelievable, the functionality, the way it's been built. He's been, really very impressed. So having come from Qantas Money, that's a big tick for us, not just being able to, get that caliber of person to work for us, but also getting that, validation of what we've been doing. Now, I will say he's only been here 2 weeks, but, it's a great acquisition for us, and his feedback has been, great validation for us too going forward.
Okay, well, that's always brilliant to hear. Now, another one here, an individual asked, tell us about your people. Is this the key to your growth? And what is happening in regard to your board now that ownership of the company has become less concentrated?
And two very good questions. The beauty of our business is we do have great operational leverage. We could double our revenue with very few extra people. So, the margins going forward now are much better at scale than they have been to date. So we're certainly looking to lift our GP quite substantially. And, we do have really good operational leverage. Look, in terms of the board, again, we're quite a different company now to we were even a few months ago. So that it's certainly something that's on the agenda that's being looked at to add some more independence to the board. I can't say much more than that, but it's certainly something that is being looked at.
Well, thank you for that one. Now, just a different style of question I've got here. Would you be able to please explain how you got a decrease of 5% in cost of sales after the acquisition? Is this the operating synergy you've been talking about throughout the presentation?
Yeah, 100%.
Okay.
So, look, one of the issues is that, a lot of things are two-edged sword. That December and January are our busiest periods. As I said, we do close to $500,000 revenue a day over that period. So we can't make a lot of changes in that period. It's just too busy to risk it.
Yep.
So some of the consolidations and people savings won't come till February when things quieten down a bit.
Yeah.
So, but also with scale, we've already seen we've lifted the margins on some of our largest selling products by sort of 4 to 6% already with scale. So, each way we turn, we see, revenue growth, we see margin growth, we see profitability growth. So all of these come with scale. So we expect all of those metrics to continue to improve, in the next 12 months.
Well, thank you for that one. Now, another individual asks, what does your ongoing tech/platform spend look like? Are you past the startup/investment stage? Is it now stable, and are you now into essentially maintenance mode?
Yes, and yes to all those questions.
Love to hear it.
They must have been in our meeting this morning. Look, we will shut down our offshore development centre probably February.
Okay.
Probably February. We already halved it in July this year. So there are about 5 sprints to go till the product development is done and we move to maintenance mode. So that's end of January, February sometime.
Always good to hear, and thank you for the timeline update.
That's a savings of around 70,000 a month.
Well, that'll certainly start to add up. Now, another one here I've got. Can you talk about the industry structure and what the current competitive environment is, please?
Yeah, look, most of our new business comes from consultants in the space. We don't have any salespeople in the business. We have someone on the content acquisition, but no one on the sales side. All of our opportunities come through consultants or direct. So if we look at a lot of the consultants have industry maps, and we sit in a category of our own because how we've set up to differentiate ourselves from, we have competitors on the software side, competitors on the rewards, individual pieces, but we've set ourselves up to be a one-stop shop.
Yeah.
Anything to do with incentives, rewards, loyalty, you can get from us. Whether that is said on that earlier slide, if we go here. So it's the whole, start to finish, content, design, marketing, brand, events, and platform. We do it all. So, that's where our competitive advantage is. Now, that probably, there are bigger and global competitors in each one of those spaces. So, we sort of sit, where the size of company, will only want to have the one supplier, not multiple suppliers. But having said that, we do a lot of work for Westpac, for Coles, for Wesfarmers, NRMA, RACV, all these. So, we're used by a lot of very large companies.
All right, well, thank you for that one. I appreciate that. Now, just a couple more to finish us off for the morning. Are you able to give us a flavour of the breakdown of the revenue gross margin of the business between, obviously, 1, estimate AS, 2, RP programs, and 3, commission sales to members?
If I get that right, there are varying GPs across our products. The rewards components averages probably around 14%. The services business, like any sort of consulting business, is 35 to 40%, and then the platform sales are literally near enough to 100%. So it's a blend and across all the parts of the business, but we work to be a 20 to 22% GP business going forward.
Okay. Right. Well, thank you for that breakdown. Well, that about finishes us off. Before we wrap things up, Ian, is there anything you'd like to leave us with?
Look, as I started with, it's a very exciting space to work in right now. I mean, you've seen stories like, Myer in the Financial Review saying that their loyalty program has saved their bacon, basically. There's a lot of stories in the press about the success of loyalty and rewards programs. It's very much, flavour of the moment, and we're smack in the middle of it. So it's exciting. We'll continue to grow and grow strongly. We'll generate, EBITDA. So it's a very exciting time for us right now, and we're really excited what the next 12 months will bring.
It's a very exciting time, and I look forward to seeing how the company progresses. Thank you very much for your time and expertise this morning, Ian. Really appreciate it. Ladies and gentlemen, thank you very much. Enjoy the rest of your day. Cheers.
Thanks, Ryan.